What is an installment sale trust? An installment sale trust, or IST, is a trust arrangement that combines special purpose vehicles with installment sales. This financial strategy is commonly used in property transactions, especially for business sales, to defer capital gains tax over time. When structured correctly, they can grow from the entire principal amount sold to the trust, growing from the taxes you deferred. This deferral can be for generations. Income is the primary goal of the IST. We can maximize income by deferring the tax, then compounding growth and return from the deferred taxes. With this strategy, we can yield additional returns from cash that would have otherwise been subject to capital gains tax. Established by Ernst & Young in 1971, the IST has been around for decades. The structured installment sale trust strategy is 100% IRS compliant since it has a similar structure to a 401k. Number 1, it's untaxed on the way in. Number 2, it grows. And number 3, it's taxed as income on the way out. The structured installment sale trust uses IRS tax code 453, a Delaware business revocable trust. The idea behind this strategy is to defer the taxes on the way in by avoiding the taxable event at sale. Since proceeds go into the trust instead of your bank account, there is no constructive receipt. According to the IRS, you are allowed a 6% net after fees payout from the structured installment sale, which we guarantee through financial planning and investment strategies. Additionally, cash in the form of loans from the assets within the trust is permitted, allowing cash liquidity for other investments. For this reason, it poses a great alternative to a 1031 exchange. When using this, your dollar is still growing in the trust when loans are taken out, allowing $1 to be used 2 times. Some of the key benefits of the IST include fully IRS compliant, liquidity or withdrawals at your request, trust investments with your direction and approval, profit or gains from deferred taxes, and ongoing income and generational income planning. Now, a warning is that this is not a deferred sale trust or monetized installment sale. These financial vehicles are out of date and will likely not last through the near future. Please talk to a financial professional for accurate, up-to-date, and reliable information regarding ISTs. Now, what is a structured installment sale? The Internal Revenue Code, or IRC, specifically Section 453, lays out the rules for handling the profits from an installment sale. So, what's an installment sale? Well, imagine you sell a piece of property, but instead of getting all the money up front, you'll get paid in installments over time, with some of these payments coming in the following tax years. Usually, when you make money, you have to pay taxes on it right away. But with the installment sales, it's a bit different. You only pay taxes on the money you've received so far. This is called the installment method of accounting. Simply put, this method allows you to push the recognition of your profit from the sale into future years when you receive the payments. If you sold a property that increased in value over time, you only need to report and pay tax on the profit you made in the current tax year. This method can also be used instead of a Section 1031 tax deferred exchange. 1031 is the rule for swapping one property for another without paying taxes immediately, deferring them. What if you plan to do this swap, but it fails in the next tax year? Safety nets, called safe harbors, can still allow you to use the IST or installment method. There are specific rules about when you can access the money from the sale and what happens if you can't find a replacement property. If you stick to these rules, you can still report your income using the installment method even if the exchange fails or goes into the next tax year. For this reason, ISTs are an excellent way to save a soon failing 1031 exchange. How does a structured installment sale trust work? Step 1. The seller sells the asset to the trust in exchange for a secured note. Step 2. The trust sells the assets to the buyer and the proceeds come back to the trust. Step 3. The trustee invests proceeds for a significant return. Step 4. The note pays out quarterly income. Step 5. At the 10th year, the trust pays out the proceeds and growth returns or renews for another 10 years like a refinance, and this can go on for generations. Understandably so, most people ask if the IRS accepts the IST. The IST only defers the capital gain tax from the transaction, not the payouts. When you receive income from the trust, you pay income tax based on your tax bracket like any other income. This means the IRS is still getting their cut. If you keep the trust for generations, such as hundreds of years, the IRS will make more money from the IST payouts in the long run from the income tax than they would have from the capital gain at sale. This is because you will be more profitable in the long run by gaining interest on the taxes deferred. Additionally, the IST complies with IRS Code 453, the installment sale. Any loans or monetization from the assets within the trust are granted without monetizing the secured note the seller receives. Therefore, to take a loan from the trust, collateral must be from a different asset, not the secured note. Avoiding this fatal move separates us from the notorious monetized installment sale on the IRS Dirty Dozen list. Since you will be paying income tax on any income from the IST, we are following all rules and regulations. Additionally, we use life insurance to wash additional taxes as stated in IRS Code 7702. This can only be done for proceeds granted after the age of 62 and a half. This is a 100% legal way to make your sale tax-free instead of just tax-deferred. Additionally, the transaction is done at arm's length, meaning the buyers and sellers act independently without one party influencing the other. We ensure this is done using our third-party trustee services such as IST admin services or CB admin services. The assets within the trust cannot be directly under your name to avoid constructive receipt, also known as taxes owed. This can be unsettling for IST users since the assets are under a different name. However, the secured note protects your interest. With the secured note granted to you at the sale, you collateralize the trust, maintaining full control. We'll go into this in the next section. By following these specific rules and guidelines, all following current IRS rulings, we can perform structured installment sale trusts legally. All this information can be traced back to specific IRS codes, rulings, and letters. We are fully transparent about the process and are happy to talk to your CPA or tax attorney about any specific questions. We've trained over 100 CPAs in this area and will happily talk to yours too. We are not hiding any cards and are more than willing to answer any additional questions you, your lawyer, or your accountant may have. For additional legal questions, please contact us. Now, for the liquidity or withdrawals at your request, the most unsettling part about most tax-deferring transactions is the liquidity. With the IST, you have fully compliant liquidity where you can withdraw from the principal invested at any time. By doing so, you will have to pay the capital gains taxes owed on a pro rata basis. Therefore, if you want to leave the IST and simply place all the funds in your bank account, you are fully allowed to do so. This is one of the most appealing parts of the IST because it gives you more options. For example, if you have a taxable gain of $1 million and owe the IRS 40% capital gains tax, every dollar you withdraw from the original $1 million invested, you will owe 40 cents to the IRS. Trust investments with your direction and approval. Upon selling your asset to the IST, you receive an interest-only secured note. According to Investopedia.com, a secured note is a type of loan or corporate bond that is backed by the borrower's assets as a form of collateral. This means that the trust assets are tied to your secured note. For example, the bank receives a secured note against your house, which is your mortgage, or car, which is your auto loan, which states that you are giving your asset to the bank if you don't pay. This works similarly with the IST, in which we guarantee you 6% net after fees payments on the principal trust value. If we don't, we are then required to give you your original principal amount invested. So, how's this controlled? You choose your collateral. For example, if you don't want to use our investing strategy, you can choose not to use our investments as collateral. You entirely dictate what your note will be collateralized against, giving you full control. However, if you choose to do this, we can no longer guarantee 6% net after fees payments with your investments, forcing us to amend the secured note so we are not on the hook in case your investment underperforms. We use principally insured insurance products combined with proven investment strategies to ensure guaranteed payment to the interest-only secured note. Since you only receive income from the principal growth, you are never required to pay capital gains tax, only income tax based on your current tax bracket. If you decide to take a larger payment that affects the principal investment, you are required to pay a capital gains tax on a pro rata basis, as stated in the Do I Have Liquidity section. Profit gains from deferred taxes. An installment sale trust is an excellent tool for tax-deferred growth, leveraging the power of compounding interest. Here's how it works. When you sell an asset through an IST, the proceeds from the sale are invested by the trustee. The money in the trust isn't taxed until it's withdrawn, which allows it to grow over time without the immediate burden of taxation. This offers 3 distinct levels of compounding interest. Number 1, interest on the principal. This is the most straightforward level of compounding. The principal is invested or the initial money from the asset sale. The returns or interest from this investment are added back to the principal, thus increasing the total amount of money that can earn interest. Number 2, interest on interest. As the interest from the principal is reinvested and generates its own interest, this second layer of compounding comes into play. Over time, this can significantly increase the growth of the investment. And number 3, interest on taxes saved. Finally, because the money in the IST is not immediately taxed, the amount that would have gone towards taxes is instead earning interest. This is effectively another layer of compounding, allowing the funds that would have been lost to taxes to contribute to the overall growth of the trust. By utilizing these 3 layers of compounding interest, a structured installment sale trust can help the proceeds from a sale grow significantly over time, maximizing the benefit of tax deferral. Now, how does payout plus growth work? The installment sale trust experiences growth in addition to your quarterly payouts. In the following example, a $1 million asset is sold and proceeds land in the trust. Let's say there's a 7% yearly gain from the trust and a 6% net after fees yearly payout based on the original principal, which is paid quarterly. This 6% net after fees payout will always be paid based on the original principal, not the current value of the trust. That being said, the note can always be refinanced to the new trust value. However, there is a 10% revenue share on gain. This does not affect principal. For example, if the original $1 million grows to $1.5 million, 10% of the gain, or $50,000, is obligated to a revenue share. Note refinances can be done whenever the note holder decides. However, they are mandatory after 10 years. Ongoing income and generational income planning. The IST may absolutely be passed on to heirs. When the promissory note is passed on, there is a step up in basis on the trust value. For example, $1 million is the IST with a basis of $500,000. This IST grows to $9 million by the time of your passing, granting your successors the note with a step up in basis. Similar to how real estate works, the new principal basis is $9 million instead of the original $500,000. This allows your heir to either take the cash or receive an income stream from the new principal amount of $9 million. This makes the IST an excellent generational wealth tool for succession planning. Where does the tax go? It's crucial to note that the deferred tax liability does not disappear. The IST just defers the taxable event. The capital gains tax is then paid as the seller receives the IST income. The key benefit lies in the deferral and potential for the overall tax burden to be spread out, not eliminated. With asset appreciation, combined with specific proper management, the trust's growth will outperform the income tax rate, allowing much more income. All that being said, using financial strategies such as whole life insurance, it is possible to completely wash the capital gains tax from the sale over some time. Life insurance allows tax-free withdrawal when above the age of 62.5. Even if you need access to the capital, you can take low-interest loans from the asset within your trust, allowing liquidity while your asset continues to grow. We would like to note that you cannot monetize the secured note itself, or else this turns into a monetized installment sale, which is not IRS approved and will result in paying capital gains tax. the monetized installment sale is only for farm-related products. You can learn more about the monetized installment sale through our partner company, CB Farmers Trust. Who benefits from an IST? Anyone who owns a primary residence, business building, commercial real estate, or investment real estate may qualify for a structured installment sale trust. Homeowners looking to downsize, landlords, investors, and business owners typically benefit the most. An installment sale trust is the only option that allows you to have a steady, guaranteed income for years after selling your property. The next generation can also inherit this income, so your investments will live on.